entertainment here. Kevin Gordon joins alongside Collin Martin, taking us into the Bell afternoon. Guys, great to see you both. Kevin, get us started on stocks. You're right that the next phase for equities may be a little less exciting. Tell me what you mean by that.
Yeah, I mean, it's mostly, with regards to the earnings outlook and where we stand now from earnings growth being still quite exceptional and actually moving further into double-digit growth territory in terms of year-over-year growth for the S&P 500. It maybe goes against conventional wisdom, but the catch with earnings growth getting even stronger from here is that it tends to be consistent with softer gains for the market, not negative performance. But when you move out of the zone, the best zone for the S&P, which is when earnings are between down 20% and up 5%, that annualized average gain is about 13% for the market. Then when you move into the zone above 5%, which we're now in, the annualized gain drops and gets essentially cut in half to around 6.5%. So I think it's, the market's way of saying the best is sort of behind us from an earnings perspective, the earnings swing factor really coming out of the earnings recession, and you're still in positive territory, but it's more of a supporting sort of background driver, not the main driver of the stock market in terms of performance.
I see. So once we get away from the constant kind of drumbeat of the numbers, then we got to get a new kind of a force, a new catalyst. I don't know if it's going to be bonds because they're getting a little shaky here, Collin.
Well, yeah, today they're a little bit shaky. We saw yields rise a little bit, a couple of disappointing Treasury auctions, but we think it's really going to come down to this week's PCE number. I mean, I think that's what really the markets are waiting for. It all does come down to the inflation outlook and what that means for Fed policy. The will they or won't they, the timing of the rate hike. I don't think we're going to stop talking about them for a while until we start to see those actual rate cuts. So we look at the market today. It was less economic data driven, more Treasury auction driven. We think the main event this week should be that PCE report.
Okay. Is the flip side then, Kevin, that when we get a slower pace when earnings is growing, that at least it's a little bit more visible, that it's a little bit more reliable? Like now that we've kind of got that as our baseline.
Yeah, I mean, I think when you look at the spread and the dispersion among sectors, that's coming more into line or into sort of balance, especially when you consider, the dominant story last year from an earnings perspective, also to some extent from a performance perspective, was the Magnificent Seven versus, the other 493 in the market. The growth rates for both of those cohorts are actually expected to be about the same by the end of this year, by the fourth quarter. So you're starting to balance out, and I think that's overall, a positive. But at the same time, once you get to this zone of earnings growth, the market tends to focus on more and not just the specific profit story. There's revenue that's taken into account. There's guidance that's taken into account, and that's what you started to see in the first quarter. The market became much more selective in terms of who was outperforming, where the premium was placed, based not just on profits data but actual revenue growth, and then weaving in the guidance aspect for the rest of the year as well.
Okay. The power of single stocks, too, seems somewhat limited here in the last couple days, kind of the last week. Definitely it still packs a punch, but have you been surprised, Kevin, real quick, to the extent to which our breadth kind of has fizzled a tad?
No, yeah, I think the breadth aspect is, worth keeping in mind, especially because you're starting to see a little bit more of a breakdown in certain sectors. But even at the index level, you look at an index like the NASDAQ 100, the percentage of companies that are above their 50-day moving average, that's been sort of consistently moving lower as that index has been moving higher. The upside is that when you kind of zoom out a little bit and bring that to the percentage that are above their 200-day moving average, you're still in relatively healthy territory. You've sort of been chopping sideways, in a little bit of a wide range, but that's still the case too for the S&P 500. So I think until you saw, more of a market deterioration in that statistic as cap-weighted indexes continue to move higher, that's when I think there would be more of a red flag.
Okay, got it. Good stats there and good distinction between the types of breadth. All right, so with Friday on our mind, some of the kind of pseudo-hawkish commentary from Kashkari today, Collin, what's going to be under the hood when we kind of combine the number with what we've heard from Fed speak about, going both ways if the data forces it?
Well, I don't know if Friday is really going to change anyone's outlook too much unless we get a super hot reading. If there's a number that kind of blows away expectations and doesn't, just beat by, say, a 10, we see a significant upside surprise. We probably see the potential for a rate hike more on the table than it is right now. Well, when we look at Kashkari's statements, I mean, he's clearly the most vocal about the level of restriction and the potential for rate hikes going forward. When we look at what other officials are saying, I don't think what they're saying is too far off, and they just don't talk about the potential for hikes because they just don't see it in their outlook. But most of them acknowledge that it is possible if the economic outlook evolved the way Kashkari is afraid of. When we hear a lot of people talk about the need, or more specifically, the want of the Fed to cut rates, I don't know how much they want to cut rates. I think they want to do what's right in terms of slowing inflation, not allowing bubbles to rise up where they worry about asset prices to a degree, but they want to do what's right for the economy. I think most officials are probably along the same boat, that if inflation's coming in hot, it certainly suggests a longer hold. And if it comes in even hotter than that, then rate hikes could be on the table. There's still a possibility there. He's just the one that's saying it the most vocal.
Got it. Nice. Well said. Appreciate that, guys. Good thoughts.